forecastwith.com. So I hope that everybody is doing great, and please kindly let me know if audio and video is okay before we start the seminar today. Good evening, Siddhartha. All right, thanks very much, guys, for the confirmation. Okay, so let's start the seminar for today. So we are, in case that you are new, we are a service company. This is our website, www.elliottwave-forecast.com, and we give Elliott Wave forecast chart to our members in 4 different time frames, and we are covering about 52 instruments right now, and we are going to add a stock plan pretty soon. So we're going to include some of the popular stocks like Google and so on into our service next time. All right, so you can visit our website if you have not, and we got a lot of free articles, also chart of the day, video blog, and many different things that you can find for free for information. All right, and good evening, everyone, and let's take a look here with the seminar now. On a stock, yeah, we have Apple right now, Amit. I can show it to you at the end, all right? All right, so this is a very quick sort of information here. Now, for you to understand Elliott Wave and how to read any Elliott Wave structure, you really need to understand this different Elliott Wave degree, right? In the Elliott Wave, we have at least this 9 different degrees in the Elliott Wave, right? From the sub-minuet all the way to the highest degree, grand supercycle. Now, if you're looking at the higher time frame, such as the weekly time frame, daily time frame, and also, mostly the weekly and the daily time frame, then you will be able to find this higher degree, higher degree in the Elliott Wave, right? So you will use this sort of labeling in the higher time frame. Then once you go to the smaller time frame, like you go to the 4 hour, 1 hour, then the degree is going to be smaller, getting smaller as well. So this is the idea or the concept of degree within another degree, right? Or waves, smaller waves within bigger waves, right? So this idea that the smaller waves together form a bigger wave is something that you need to be familiar with in order for you to be able to understand Elliott Wave in general and be able to read the structure. Now, having said that, today we're not going to focus on this label thing, but this is some sort of reference for you, and we can go back to this reference later on to be able to understand the flat structure. So we're going to be focusing today specifically on a flat structure and how we can identify a flat structure when we see it on the chart, and what kind of tips that we can get when we are finding or when we are facing a flat structure in the chart. Okay, all right, so first let's talk about the difference between a flat structure and a zigzag. Okay, so how many of you are familiar with these two different Elliott Wave structures, or most of you are new to Elliott Wave? How many of you are completely new, and how many are kind of familiar? Okay, so a lot of new people. Okay, great. Anyone that knows a little bit? Familiar but never used. A little. Okay, great. It's all right. So if you got only little understanding, little information, that is perfectly fine. A flat is actually, in Elliott Wave, this is the most confusing structure. This is the most confusing structure out of all the different structures out there in the market, right? This is the most confusing structure. Now, a flat a flat in Elliott Wave is labeled as an A, B, C. Now, how many have heard an ABC structure in Elliott Wave? A, B, C. A, B, C. Yes, I can explain that, Antonius. Right. So an ABC basically usually is being used to label a corrective structure, right? So in Elliott Wave, you got two main different sort of structures. One is called impulse. Now, when you are talking about impulse, usually that means that it is the trend. That's where the trend is. So an impulse consists of 5 waves, right? So if the trend, let's say, is going up, you will see a 5 waves up. If the trend is going down, you will see a 5 waves down. But an ABC, on the other hand, is corrective because it's only 3 waves, right? Now, the ZigZag is the most sort of popular one for people who know about Elliott Wave a little bit. Okay, a ZigZag is nothing more than 1, 2, 3, and I'm talking about this ABC in the red degree, right? Now remember, we got the black color and the red color. So what's the difference? Again, that will relate to this different degrees that we talked about earlier. So that red color is the minor degree, and the black color is one lower degree, or the minute degree. So when you try to read the charts like this, so what that means is, all right, so this is actually a 3 waves, an ABC, but if you break down into a smaller sub waves, the A here consists of 5 waves down, and then the C here consists of another 5 waves down as well. So an ABC is a pretty simple structure. Most people are familiar with that. It's a 3 waves corrective structure. When you see 3 waves, that is always corrective. It will never be impulsive, right? Because it's only 3 waves. So in this particular case, usually in the C leg is going to travel, okay, the C leg or the third leg is going to travel approximately 100% of the first leg, or the A leg. Okay, so one of the sort of guidelines is that, okay, when you suspect you will have an ABC structure, then your target from the C is going to be about 100% of the A. Okay, so that is a ZigZag. It's very simple. So what do you get here? A sequence of a lower low, or on the bullish side, it will be a sequence of a higher high, right? A flat, on the other hand, people mistakenly confuse, between the two, because it is also labeled as an ABC, the same as a ZigZag labeled as an ABC, right? So people might think, well, this is a ZigZag, but it doesn't look like a ZigZag because this is not a ZigZag, this is a flat. Now, a flat is different than the ZigZag. Think about a flat as a sideways consolidation, if you want to put it that way, because you can see that the B is kind of retesting the starting point of the A, sometimes can even bypass a little bit. Okay, so the B is it can retest, a deep retest of the starting point of the A, or can bypass a little bit, and the C can be retesting the A or even more than the A, depending on, there are 3 different types of flats, but I just want to give you an idea what a flat is about. A flat is nothing more than a choppy price action, basically, right? Where you got a move down, a move up that retest the high, and then another move down. So it's somewhat sort of like just a sideways range, so to speak. All right? That's correct, Samara. If you see the internal of the A is in 5 waves, all right, then that cannot be a flat. Correct. It cannot be a flat. Okay. Now somebody asked me earlier. This is a good question. Let me paste all the good questions from you guys. So this is a question from Antonius. Why do you use WXY instead of ABC for the lower degree of A? Okay, that's a very good question. Now, a WXY is another structure that we will not talk about it today because that will take some time to explain, but it's pretty simple. Okay, if you want to label this as an ABC, which you can, what is the requirement if you want to label this as an ABC? Because if this is an ABC, what types of structure is this, guys? If you label this as an A, B, and then C, that is a zigzag, right? Now, a zigzag like this, what is the requirement of a zigzag? The internal of the A must be in 5, right? So this means if you label this as an A, you must have a 5 waves here. And you must have a 5 waves here if you want to label this as an ABC. Correct, 535. So if you do not find a 5 waves here, instead you only find 3 here, you only find 3 here, then you label this as a WXY. Now this webinar is for beginner, and also, I mean, all kind of levels I think can benefit from it. I try to explain it as easy and as basic as I can be. So if you do not understand any part, feel free to ask questions. All right. So is that clear about the question, Antonius? Why we label this a WX? It really depends on the internal. If the internal is only 3 here and 3 there, then I cannot label this as an ABC. Okay, you're welcome. So the same thing here as well. This is also another 3 waves. So when you see a 3 waves, Antonius, it's not always an ABC. It depends whether you really got 5 waves in the A or 5 waves in the C or not. If you do not see a 5 waves in the A and you do not see a 5 waves in the C, then you cannot label this as an ABC. You need to label it as a WXY. WXY and an ABC are they are very similar. Okay, they are 3 waves, right? The only difference here, I can label this W if I see 3 waves here. I can label this X and I label this Y if I see 3 waves here. But other than that, everything else is the same. So you would expect the Y, okay, is equal to the W, just like you expect the C is equal to the A. Okay? Yes, it's usually how, okay, got a lot of questions here. Let me see what else. Let me copy some of your questions again, guys. All right, so this is a question from Samara before. So the question is, if with A comes in 5 waves, so it must be a zigzag, not a flat. And the answer is yes, because a flat, think about a flat as, okay, so we got similarities and differences here, right? The similarities between a flat and a zigzag, both are 3 waves. ABC is 3 waves. ABC, 3 waves. They are corrective. Both also labeled as ABC. The difference is a flat is a 3, 3, 5, while zigzag is a 5, 3, 5 structure. Okay, so this is the main difference between the two. And also, of course, the fact that this is simple, ABC is a simple, like, this is straightforward. The C is going to be lower than the A, but not the case with the not the case with the flat, right? So in this case, the B is going to be always lower than the starting point of the A. The C is always going to be lower than the A. But in a flat, in a flat, it's not the case. The B can be retesting this or even bypassing this starting point. The C can be retesting the A or even bypassing the A. So that is sort of the key differences between the two. So think about a flat as sort of sideways consolidation or choppy price action, if you want to call it that way. And then we're going to take a look at some of the tips on the flat also. all right? And because there's a lot of traps in a flat, guys. There's a lot of trap that if you are not into the Elliott Wave deep, you will fall into this trap. For example, one trap that people always make when they are relatively new to Elliott Wave, when they see 5 waves down, for example, a lot of people who first started Elliott Wave, they try to always find the 5 waves in the chart. And when they find the 5 waves, like this, for example, 1, 2, 3, 4, 5. So when they find a 5 waves, when they identify a 5 waves, right, they are happy thinking that, okay, after 3 waves pullback, I can sell it because I see a 5 waves, which is the trend, so it must give me another 5 waves down, right? That is usually what people think, right? They try to identify 5 waves. So let's say you find a 5 waves like this, 1, 2, 3, 4, 5. Great. Now I sell 3 waves up because I see a 5 wave. So I'm guaranteed to get another leg lower because this is the trend and this is the correction. So I should get at least another 5 waves down, right? But they forget that there is this thing called the flat, right? Now remember, imagine you got something like this and you are able to identify 5 waves in your chart. 1, 2, 3, 4, 5. And you think to yourself, okay, I am able to identify 5 waves down. So now I can sell a 3 waves up, just like ZigZag, like 3 waves up, I'm guaranteed to make another leg lower. But is that always the case in the case of a flat, guys? It's not, because a flat is different than a ZigZag. All right, we're going to take a look at the chart to give you an example. Let me see if I have, okay, this is the chart. Let's say this way, guys. Let's say I have a bullish trend. I have a bullish trend, and then I need to correct this bullish trend, right? So the correction is in 3 ways, right? Always, the correction is 3 ways. The correction can be a flat, a ZigZag like this. Now we already learned about the ZigZag, right? And I label this as an APC, right? So if the trend is bullish, after 3 waves down, the trend, the bullish trend should continue, right? Everybody understand, right? This could be 5 waves here. If you only familiar, if you only know about 5 waves, so let's put it this way. You got the 5 waves, right? Which is what you call impulsive. 1, 2, 3, 4, and then 5, right? Then after 5 waves, you got a 3 waves correction, right? So that's what the Elliott wave is telling you. After 5 waves up, you got a 3 waves down. And then you tell yourself, and then you get another leg higher, right? So this is a simple correction. Now imagine this way. Instead of correcting in a ZigZag, it does an A, a B, and then a C. You see it? This is an APC. This is a flat, guys. So you got the C in 5 waves also here, right? So in other words, if you do not know, if you only see 5 waves without knowing the bigger structure, you can be mistaken thinking that, okay, after 5 waves down, I will always get another 5 waves down, right? You will be mistaken to think it that way. So in a flat, right, in a flat, this means if the trend is bullish, the trend does not even need to be in 5 waves, which makes it even more complicated. Let's put it this way. You only have 3 waves here. Let's say you only can find 3 waves, right? It's because it is 3 waves, and this is not 5, and the internal of this is not 5 waves. You label this as a WXY, right? Because this one is subdivided into 3, so you cannot label that as an APC. So I will subdivide it for you so that it looks clear. So you got something like this. So you only have 3 waves from here. And then you got a flat correction like this, an ABC flat. And a flat, the C leg is in 5 waves, right? So without knowing the bigger structure, you would think, okay, well, after 5 waves down, I can sell it to get another 5 waves down. Not necessary. Because if the trend is bullish, right, even it's only 3 waves up, and then 3 waves correction, it can start to go higher like this again. Okay, so in other words, 5 waves do not tell you about a lot of things unless you know the bigger structure, right? Unless you know the bigger structure, 5 waves does not guarantee anything. All right. So this is a flat versus the zigzag. One of the mistakes that people commonly make is they think that if they can identify the first 5 waves, they are guaranteed to get another 5 waves, which is a mistake, right? Because the 5 waves, you should ask yourself, is this part of a flat or not? That is the first question you must ask yourself every time when you find a 5 waves. Okay, is this part of a flat, right? That is the first question. Now let's take a look here. All right, got up several other questions, but let me continue this first. Okay, now there are 3 different types of flats. Don't be confused with this, guys, but all of them is choppy move, all of them is sideways move, right? You can see this is a regular flat where the B is gonna retest the starting point of the A, and then the C also is retesting the A. Okay, so you got a regular flat like this. So this is pretty simple. It's like almost like a sideways. Okay, in a regular flat, usually the C is going to go over a little bit the A. Now in the irregular or expanded flat, this is the most common. Irregular expanded flat is the most common types of flat in the market. You got an A and you got a B that go way above the starting point, and then you got a C that go way below the A. So this is what you got, something like this. This is the most common. But it's also a 3, 3, 5. Is the difference is just where the B ends, where the C ends out of all these 3 different types of flats. Okay, and then the last one, the running flat, you got the B either retesting or go above it, and then the C fails above the A. Okay, fails above the A. So that is what you call a running flat. So it's just where the B and C terminates is what differentiate between these 3, but overall they are you can consider it like a choppy price action. Okay, now let's take a look one by one. This is the regular flat, this is the roll. Okay, the roll, so it's a corrective 3 waves labeled as ABC. The subdivision of the A and the B is in 3, right? So this is why we call it a 3, 3, 5 structure. Subdivision of C is in 5 waves. Okay, and then the wave B terminates near the start of the wave A. That is the characteristic of regular flat. Wave C generally terminates slightly beyond the end of wave A, so slightly beyond the wave A, and wave C must have momentum divergence. So this is also important. Momentum divergence, anybody knows what it is? It's usually a lot of people use RSI, okay, indicator. Now when you have an RSI divergence, that is what we call a momentum divergence, right? So at the end of the C, you should be able to see the RSI not making a new low. So the price makes a new low, the C goes below A, but the RSI is not making a new low. Okay, yeah, and the MACD is also all right. You can use MACD, you can use RSI, whatever momentum indicator you're using. Okay, And then in terms of the Fibonacci, stochastic also, yes. In terms of the Fibonacci relationship, the wave P is at least 50%, but most of the time is a deep retest of the A. So I'd say most of the time is between this Fibonacci ratio here, 76.4% retracement or 85.4% retracement of this wave A. So that is usually what the wave B is. And then the wave C usually is between 61.8% to 123.6% of the AP. Okay, so we're gonna take a look and see how to measure this Fibonacci in the chart. Okay, so we're gonna take a look at example of a regular flat. Okay, give me a moment here. Let me see what I have as an example. All right, so here we go. This is TNX daily chart. Anybody knows what this chart is? TNX. Wave C is always in 5 waves. TNX is a 10-year yields. This is a 10-year yields, the bond. So if you're trading bonds, this is the rate, 10-year rate. Okay, it's called TNX. Now you can see if we look at it from here, starting from the 0. Between the A and the C, Samara. Okay, starting from 0, what do you see here? It's A. So like I said, it's like a choppy consolidation, right? Like I said, you can see, right? The B retesting the start, and the C terminates slightly above the A, right? So this is a flat. Now the example we have is the, I don't know, this is like the bullish flat, and this one is the other way. This is a bearish flat, right? A bullish flat will be A, B, C. This is the one that is in our slides, which is a bullish flat. This is a bearish flat. It's the other way around. So A, B, C. The B retests the starting point. The C terminates slightly above or below the A, right? A, B, C. Now let's take a look at the smaller time frame of the TNX in the 1 hour, so we can get a better view. Okay, there we go. Now I'm looking at the hourly chart now of the TNX. That is zooming in. I'm zooming in here, and so I can get all the internal subdivision. I'm zooming in here in the 1 hour now. Now I'm going to the 1 hour. Starting from the 0, I got A, right? I got an A. I got B. I got C, right? A flat. Now look at this. We got 3 waves from here. 3. We got 3 waves here. 3. We got 5 waves up. Right? 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5. 3, 3, 5. All right? Everybody can see it. Now, if you look at the internal, that's how you want to label. Now, you see the different degrees here, the different labels. That's why, like I tell you, for you to be able to read the chart, you need to understand the different degree. Like this one we talked about earlier, and the black degree is called the minute degree. Back here. This is the minute. One lower degree than the minute is the minuet, I guess that's how you pronounce it, and then 1 lower degree is the subminuet. So if you go back here, so this blue one is 1 lower degree than the black, the red one is 1 lower degree than the blue, and that's how you can identify how to read the structure by understanding the different degrees. All right. Now, you can see right here that this is the RSI below here. Okay. Now you can see that this C here has a divergence, right? It makes a high in the price, but not in the momentum. The momentum is making a lower high, the price making a higher high. So like we said earlier, the wave C, at the end of the wave C, it needs to have a momentum divergence. All right. A flat is not something that is easy to trade, Ted, unfortunately. Even in the Elliott Wave desk, even in our company, in our live trading room, we usually avoid a flat. We usually avoid trading a flat. We only trade a simple 3 waves, either WXY or a ZigZag, but not a flat. And a flat is always tricky, and the trick is in the following. The trick is in the following. You do not know this C leg can extend quite a lot. That is the problem with a flat. Okay, but it's gonna take another hour to explain about how to trade, right? It's another different topic. In this seminar, we're gonna be focusing primarily on identifying and learning the the trap in a flat. Okay, so this is the regular flat is pretty simple. So you got a B that is retesting this starting point of the A, and you got the C ending slightly beyond. Now you can see that the P here almost is at 100%, right? If you measure the retracement, so it's always a deep retest. I would say that most of the time the P is gonna lie somewhere in this region between 76.4 and the 85.4% retracement. And the C, on the other hand, okay, the C is going to be, you need to use 2 different types of Fibonacci tool in your chart. One is Fibonacci retracement. The other one is called Fibonacci expansion or Fibonacci extension. So if you are using MT4, for example, you can Google yourself Fibonacci expansion. But this is the way you measure Fibonacci expansion. You have to use 3 points from 0 to A, and then you measure it from B. So you got here, right? It stops exactly at the 1.236 extension in this case, right? For the wave C. So as we said, wave C ends between 61.8% to 123.6% of the AP. Okay. Can you give me a moment, guys? I'm gonna take a glass of water and coming back very fast. A flat is not always in the wave 4, Antonius. It's not always in the wave 4. A flat can happen in any corrective structure, right? No, we can identify Elliott wave, right? We can identify Elliott wave. I'm just explaining the flat is always the most tricky out of all the structures in the Elliott wave. There is a simpler structure that is straightforward, but the flat always is the trickiest. Okay, so this is a regular flat. Let's take a look again. Another one. This is an expanded flat. Now expanded flat, the difference is in here. With B terminates beyond, and with C ends substantially beyond the A. So we got this type of move. This is the most devastating types of flat, to be honest, and I will tell you why. And then the same with C must have momentum divergence. So this expanded flat, the C can extend even beyond 161.8, even though the guidelines is between 123.6 to 161.8. In reality, sometimes the C can extend even beyond 161.8. Okay, and let me give you an example here. Now everybody should know this chart, should be familiar with this chart. This is the S&P. Okay, this is the S&P chart. Now look at this. This is starting point, which is the year 2000. Anybody knows what this is about? This is all about, this crash here, 2000 to 2002. Anybody has traded that long? .com. That's right. That is the .com crash. Anybody knows this? This is more recent, 2007 to 2009. Anybody knows what this is? Yep, the Lehman Brothers. Right. So very strong move. Everybody is so scared at that time, right? And it looks like, oh my goodness, it's gonna go to zero, right? It's gonna go to zero, and then it keeps rallying until today, right? Now, this is an example of an expanded flat, guys. Very devastating, right? Now the thing is this: why is it very devastating? Is the following. In the trading world, right? A bullish market is a market where you get higher high and higher low. Okay, the definition of a bullish market is as simple as this: a market where you get higher high and higher low. Right? Everybody understand that? Same idea with a bearish market, the other way around. A bearish market is a market where you get a lower low and lower high. Now the problem with the flat, right, is the following. Here in the year of 2000, you got S&P at 1553. Okay, S&P is at 1553. And then here in the height of the 2007, you got 1576. All right, so now using this definition, you would say to yourself, great, S&P has broken the previous high, so it makes a higher high, so it is bullish. So this means everybody is very bullish the market because it breaks this. So everybody will start thinking the following. When you got an instrument breaking the previous high, okay, you automatically think like this. All right, it has already started the next leg higher, and where is my target going to be? You will use simply whatever starting point here, a 3 waves up, where this leg is going to be 100% of this leg. Everybody understand? Once you get a higher high, automatically a lot of people, computer program, everything is going to think, okay, well, it's gonna extend until this is going to reach equal 100%. The problem with the flat is the following. It tricks a lot of people thinking that it breaks the previous high. So you might call it double top if you want to call those that do not follow Elliott Wave. Sometimes they call it double top. All right, then significantly, strongly turns lower again afterwards. So in other words, this is the sort of the main takeaway point. When you only have a marginal high, or when you have a deep bounce, like almost retesting this, be careful of trying to buy a 3 waves. Because remember, in the Elliott Wave, people always buy and sell a 3 waves. Because they always say, if the trend is 5 waves, I believe the trend is up, so I'm going to buy 3 waves down. 3 waves down, I'm going to buy it. I'm going to buy every 3 waves down. The problem with that is when, okay, the mistake or one of that we need to be careful about is when you see this leg here, a deep retest of this first leg, you always need to question yourself, okay, this may not be a simple ABC that will end at 100%. This could be a flat because it's a deep retest. So if this is a flat, then the C here can be strong and can even go to more than 161.8%. All right, that is sort of the takeaway points. So if the bounce, the correction is only at 50% approximately, then I think you will have a better chance if you're trying to buy a correction in 3 ways, for example, buying at the 100%, you will get a much better chance getting it right than if the bounce actually is deep. Now, if it breaks this, don't be happy. If the break is only marginal, it's not really like a real break, then it can become a flat, especially if you see the reaction lower is strong, then you know, okay, it can be doing a flat. So that is sort of like a takeaway points. Depending on how deep the second swing correction is, then you will know whether it can be possible to become a flat or not. So somebody asked me earlier, how do we identify a flat? Well, it really depends on how deep this is, right? If it is a deep bounce, start thinking, okay, flat is possible, flat is possible. If it makes a marginal high, it's not necessarily bullish, only marginal. So you can say, okay, it can be an expanded flat. Okay, it can be an expanded flat. So as far as the second swing is a deep retest or a marginal high, you can always get a case of a flat. Okay, so in this case, it's really a flat. You can see, so from here, we got 3 waves down, 3 waves up, strong impulsive 5 waves down. It is mostly respected other than expanded flat, Michelle. Expanded flat, like I said, can even go past beyond 161.8. But mostly this is sort of the general kind of range that you should be focusing on. All right. Yes, I think I got an example, Godfrey, with currency pair. Let's take a look. This is Aussie dollars, a 4-hour chart. This is an example of expanded flat. Starting from here. Now, you got an A, a B, and then strong move up in 5 waves, ABC. The thing is like this, right? Like I said, expanded flat is devastating, guys. Everybody will think that, okay, I got this move lower in the Aussie, I got the bounce, and I got a new low. Okay, without knowing this, if I do not know this, what do I think, guys? Bearish or bullish? Remember the definition we learned earlier. It's a sequence of lower low. It is bearish, right? It is bearish. So this means that a lot of people will start thinking it can go to 100% here, not knowingly that it is doing a flat. So a flat is something that is very tricky. So again, as far as the continuation is not significantly much lower than this, you always run the risk of doing a flat like this. You always run the risk of doing a flat. So a flat happens everywhere, not just, you know, not just currency or indices. It happens everywhere. Okay, lastly, the running flat, and then we can take a look at some examples and then also answer some of your questions. Running flat, the only difference is the C fails above the A. This is the rarest pattern. Okay, this is happening the least frequent in the market, the running flat. The expanded irregular flat is the most often. This is the least often. Okay, it says where the C and B terminates. That's the only difference. Now, as an example of this, we can take a look at the pound New Zealand dollars. This is a daily chart of the pound New Zealand dollars. Now look at this. From here, from 0, we got 3. We got your correction, the B. The B in this case is just a retest of the beginning of A. And then you got the 5 waves down, the C, failing to extend beyond this. So this is an example of a running flat. All right. All right, so Amit wants to look at an example of a stock. The problem with this, Amit, is I don't think my eSignal here has the possibility to look at a stock. I don't think I can open the Apple here. I don't have the enough, yeah. I cannot open Apple, but I can show to you from our website just to give you an idea. Okay, just to give you an idea. Let me see. So this is our website, www.elliottwave-forecast.com. Now, if you're a member, you can log in and then click on the member area. And then on the left side, you got Elliott Wave charts grouped by different instruments like the yen, the US dollar, cross, index, commodities. And then we also have the plus plan, which is a lot more additional commodities, index, and Forex. Now, over here in the indices, right now we have only one stock, which is Apple. But we are planning to add a lot more different stocks, Google, IBM, some of the most popular ones in a stock plan very soon, like 20-something probably. But that's still not yet. So far now we cover around 52 instruments here. Okay, 52 instrument. So for Apple, I can show you an example. It's the same. So this is how this is the 1 hour chart, for example, right? And we are labeling it as such. So this is an example that you want to see an example. Not necessarily a flat, it depends on what type of structure it makes. But so this is the way we do it. And then we also have a 24-hour chat room. You can ask questions if you want to ask about anything. And we have a technical analyst answering, and we also have live sessions every time. We have live trading room every day which gives you a setup like this. So we provide you with a setup like this, right? And also the video, this is every 7 a.m. Eastern time. All right, so the setup is using our technique, how to identify a trade and so on. This is just a quick sort of overview of our website. Okay, so let me see what other question you guys have. How should we ignore the noise for a proper wave? All right, so that is I guess for labeling the chart and trading it are two different things, Siddhartha. Now for us to actually trade it, we need to identify certain things that need to happen. We usually have two time frames we look at. Okay, so we identify a sequence in the higher time frame that is incomplete. Let's say we identify, okay, it is a bullish sequence in the 4 hour, let's say, and then when we identify that, we know the target still not yet reached, then we go to the lower time frame to buy the pullback. That's what you do. That's what we do in the live trading room every day. We scan the market and then we identify this type of possibility, and then and then we can trade it. Now, if you are new, you can always join free. We got a 14 days free trial, right? And then we have if you're interested, I guess it's not a must. I mean, I'm just explaining the flat, and then we got 4 different types of plan. And also, if you are interested to pursue further education, you can go to educational here, go to educational products, right? You can buy a package here, which includes one-on-one session with our technical analyst. You can talk with our technical analyst in private webinar. You can ask any question, including, and then this package includes also a sort of a MP3 recorded educational file. So on top of the MP3 educational files, you can talk to our technical analyst as well. So this is if you want to pursue more about education, you can go to educational section, and if you go to services, you can even just buy the educational only. So if you don't want to include the training, you can just buy the different class. So Learn Elliott Wave is the basic Elliott Wave class. This is the newest one, teaching you correlation, trading execution as well. So these 4 here are our classes. This 4 here is the bundles, the Platinum Premium, and also the Premium Plus. All right, let's take a look at your question. How can I label C in 5 ways? However, the rules with 4 must not overlap with 1. Well, that is the rule if it is an impulse, Samara. Now remember, a 5 waves can be a diagonal and it can be an impulse, right? So 5 waves do not necessarily have to be impulse. It can be a diagonal. A diagonal 5 waves, each wave, like wave 1, wave 3, wave 5, can be subdivided into 3 waves. So that is something that you should be aware of. Okay, so here, okay, right here, a 5 waves impulse is doing this. This is impulse, very straightforward, right? But a diagonal is like this. Something I cannot draw it well, but a diagonal is, it's like a wedge. Think about a wedge. That is what a diagonal looks like. So in this case, in a diagonal, you can have an overlap. But in an impulse, you cannot have an overlap. We do not do harmonics, Ronald, even though we do a lot of the Fibonacci extension and retracement. Okay, you can send me an email if you want this presentation. All right, let me send you guys my email. And we usually post it as well in our website after we finish processing. Okay, we also post it in our website, so you can check our website after a day. For example, in the main website, we usually post it in the video here. We usually will post it here in the video blog. All right. All right, guys. So that is the presentation for today. I hope that it is helpful a little bit in understanding what a flat structure is. All right, and we will do like simple short presentation like this every now and then. So follow us in the Twitter or in the website to see the next time we do something like this, a seminar for you guys. All right, guys, you're welcome, guys, and have a good day, everyone, and see you all again next time. Bye, everyone.